Here are 7 investing rules I would never break as someone who's made hundreds of thousands of pounds in the stock market. Now, most people don't make money in the stock market, not because they're unlucky, but because they don't stick to these basic rules. And these rules have come from personal experience. This isn't wishy-washy theory that I've conjured up from staying on the internet too long. These are based on my personal experience, having lost money doing different things, having made money doing different things. I found what works and I've made an investing strategy and I stick to it. So I'm sharing that with you today. And these are the exact rules that I stick to every single time I'm investing in the stock market. Remember, the goal isn't to be right every single time. The goal is to stay in the game long enough so that you win. Rule number 1 is super simple, but so many people get this wrong, and that is to never invest more money than you are willing to lose. I see so many people that over leverage themselves when it comes to the stock market. They invest more money than they're willing to lose, and then when it does go wrong, they find themselves in trouble. Now, this is the easiest rule to follow, and this one rule will help you in so many different situations. Only invest money in the stock market that you are willing to lose. If you can stick to that rule, if things ever do go wrong, then you've only ever lost what you're willing to lose, and you save yourself a lot of headache and a lot of heartache. The second rule that I stick to religiously is never using leverage when it comes to my investing strategy. So I only ever invest in cash. I only ever invest with money that I actually have in my portfolio. I'll never take leverage out. Now, you might see some people online talk about trading using leverage or talk about investing using leverage. And this is where they're essentially trading with a multiple of the amount of money that they have in cash available. So, for example, I could have £1,000 I'm investing into the stock market, but I could be trading with a 10x leverage, which would basically mean that I have the power of £10,000 to invest with. And that is where people get themselves in trouble because leverage is great when you're making money, but leverage becomes your worst enemy when you're not making money and you can end up losing way more than you've put in. So if you are investing and you want to invest over the long term, do not use leverage. Now, there might be some people out there that do very well from investing using leverage. I am someone who has never personally considered it. It's not something that I would do. I always stick to the old-fashioned method of investing money that I actually have in my account. So if it does go wrong, I know that I can pay it because it's money that I've invested. And if I stuck to rule number 1, it's money that I can afford to lose. So I shouldn't find myself in any trouble. Rule number 3 is understanding risk management before you enter a trade. So I see a lot of people that get caught up in hype stocks, that get caught up in investing 100% of their portfolio in risky things or things that they don't fully understand. Now, if you are managing your portfolio, you need to have a good understanding of risk management and what that means for you. So for me, how I look at risk management is I would only ever invest 20% of my portfolio capital in speculative stocks. So these are stocks like Archer Aviation, stocks like Surf Air Mobility, stocks like Sidus Space. These are very high risk, high reward stocks. And I make sure that these stocks don't form more than 20% of my portfolio. Now, the reason I say that is because if I had 100% of my portfolio in some of these stocks and they go down 40 or 50% overnight, then my entire portfolio is down 40 to 50%. And I never want that. I've always been someone who wants to create a long-term sustainable portfolio. And the way that I do that is by investing 20% of my money in speculative stocks, but keeping 80% of my capital invested in blue chip stocks. These are stocks that are household names, stocks like Amazon, Apple, Google, and Nvidia. These are stocks that have stood the test of time and stocks that I don't have to worry about when I go to bed. If I'm holding Nvidia, I don't have to worry about going to sleep and waking up 40% down. It's just not going to happen. And that's how I look at my risk management. If you are investing in the stock market, you need to understand risk management. And it is different for every single person. Now, some people will want to allocate more of their money towards speculative stocks than I have. That's completely their prerogative. I keep a maximum of 20% of my capital in speculative stocks. That's just the risk that I'm open to. That's the risk that I'm willing to take. You might be different. You might have a different risk appetite. But before you start investing, you need to understand what risk management looks like for you. Rule number 4 is to never invest without doing due diligence. And this is something I see people break time and time again. Now, in my opinion, you shouldn't be investing a penny into a stock until you've done your due diligence into it. You need to understand what that stock does. You need to understand who's running the show. What's the CEO like? What is his track record or her track record? What are the management team like? What have they done before? What companies have they transformed? What companies have they turned around? What are the financials like? Is the company pre-revenue? Is it pre-profitability? Does it make revenue? Has it made any profit? What are the ratios like? What's the price to earnings ratio? What's the price to earnings growth ratio? What's the price to sales ratio? How much debt have they got? What are analyst forecasts like? There's a bunch of different touch points that you need to look at before you invest in a company. And I can't tell you how many DMs I get from people on social media where they've invested into a company without actually knowing what that company does, what business that company operates in, what the total addressable market for that business is. They just know nothing about the company, yet they've invested thousands and thousands of pounds into it. And then they message me when the company goes down 30 to 40% because they just don't know what to do. And this is a real problem, especially with the rise of social media. A lot of people are talking about stocks that they're hyping, stocks that they themselves haven't really done any due diligence into, and it's causing a massive problem for newbies in the stock market because they're investing way too much money into these stocks, more money than they can afford, going back to rule number one. And that's leading to people getting into real problems. So something that I always stress is before you invest in any stock in the stock market, you need to understand, one, how to do due diligence and how to do it successfully. And two, you need to ascertain a certain level of conviction in the stock before you invest in it. Because when you have conviction in the stock, it helps when that stock is down. If I'm down 20% on a stock, but I've done a bunch of due diligence on it and I'm comfortable with the amount of money that I've invested in it, I'm not going to panic. Whereas if I YOLO £10,000 into a random meme stock that I don't know anything about and it goes down 50%, I'm going to start panicking because I don't know anything about that stock. There's nothing to make me feel better about that stock. There's no due diligence or conviction that I have that things are going to get better. Whereas when you have conviction and you've done due diligence, it helps you to sleep at night. Rule number 5 is to always have an entry and an exit plan. Now, I see so many people that get into positions and they have no idea what entry they want for a stock. They have no idea what exit they want for a stock, and they have no idea what their journey is going to look like. Now, before I enter any position, bear in mind, I'm a long-term investor. So anything I enter is typically going to be for a number of years, at least 5 in most cases. Now, before I enter a stock, I always think about what is my entry going to look like? Now, for me as a long-term investor, my entry point doesn't really matter as much as someone who's a shorter-term trader or a day trader, because then entry points really matter. Now, because I'm investing for a number of years, normally at least 5, my entry point is less important. But what I do want to think about is my exit. How long am I going to hold that stock? What is my contingency plan if the stock drops 20% in a day? Is it going to worry me? What is my average going to look like? Am I going to buy this stock once and then leave it for the entire 5 years? Or am I going to look to top up my position and maybe average down if things go the other way? So you got to really have a strategy when it comes to a stock, and you got to know what your journey is going to look like, what your entry point is going to be, what your exit point is going to be. And this helps you form that thesis for a stock. Don't just jump into something blindly without knowing what you're doing. Understand what your entry and exit points are, and it's going to make your journey a whole lot easier. Now, rule number 6 builds on rule number 5, and that is you need to understand what your time horizon looks like before you start investing. Now, for me, my time horizon pretty much stays the same no matter whether I'm investing in blue chip stocks, speculative stocks, riskier plays, less risky plays. It pretty much is always a 5-year hold for me. And that's because I've made most of my money in the stock market investing over the long term. I'm not really a short-term trader. I'm not really a swing trader. I'm definitely not a day trader. I'm a long-term investor. And that's what's made the most money for me. So that's a strategy that I've stuck to. But everyone is different. And every single investor that you speak to, everyone that you see on social media is going to have a different point of view when it comes to investing. So you need to understand what your strategy is. Because if you're listening to someone who's talking about day trading, their strategy is going to be different from yours if you're a long-term investor. So you need to make sure that you are aligned to whoever you're listening to, or you're aligned to whatever approach that you're taking. And it's very, very different. For example, someone who's a day trader might hold a stock for 3 hours, whereas someone who's a swing trader might hold a stock for 3 months, whereas me, who's a long-term trader, might hold a stock for 3 years. And there's different ways of approaching it. There's different things that you need to take into account. For example, I don't really care about earnings reports. I don't really care about short-term volatility when it comes to investing in the stocks that I invest in. Whereas if you're a swing trader holding a stock over 3 months, and that 3-month period happens to straddle an earnings report, you're going to be really concerned about that earnings report, because that's either going to mean that you make money or it's either going to mean that you lose money, depending on whether you're long or you're short. So you need to understand your strategy, because it really ties into your time horizon and what that looks like when you are investing. And rule number 7, and the final rule for me, is to not invest in any stocks that are memes or pure hype. And I actually broke this rule, funnily enough, very recently, and I ended up getting burnt. I invested £5,000 into Beyond Meat. A few of you might have seen it. It's a massive meme stock. Obviously, Beyond Meat has fallen from grace, and no one really buys their products anymore. The company is literally in the dumps, and I invested £5,000 into them, thinking that I could make some short-term money because it looked like a short squeeze was occurring. And what happened was actually I lost money. I lost £3,200, and I exited that trade with £1,800, having entered with £5,000. So I ended up losing £3,200, which wasn't great. But again, just buys into my rationale as to why I don't invest in meme stocks and why I don't invest in hype stocks. So that's something I generally don't break. I know I had a little blip with Beyond Meat, but in general, it's something that I stick to. I don't invest in meme stocks. I don't invest in stocks that don't have any fundamentals. I need to see proper fundamentals when I'm doing my analysis. And that goes all the way back to my rule around due diligence. I need to understand what I'm investing in. I need to understand what analysts think of it. I need to understand what their financials are like, how much debt they have, how much money they make, how much of the total addressable market do they capture. All of these things are super, super important when it comes to investing in the stock market. And these are things that I really need to consider before I pull the trigger on investing in anything. So you can invest in meme stocks. Yes, you might be able to make money over the short term, but over the long term, I've made way more money investing in good, solid companies, blue chips, some of the more better speculative stocks that change into growth stocks, stocks like AST Space Mobile and Rocket Lab. So if you are investing in meme stocks, just understand that it is 100% risk and you can lose all your money. And I found that out firsthand with Beyond Meat. So those are my 7 rules. Now, I think part of being a mature investor is understanding that you're not going to win every single investment that you make. You're not going to win every single stock that you enter. But by sticking to these rules, you can really stack the chips in your favor and become a better investor over time. If you want to see more frameworks and resources from me, click the link in the description, and I'll see you on the next video.